Hello, I'm Dave Zussman, and I'm the executive manager of the Distress Realty Fund 3 LLC. The managing member of that fund is Realty Fund Management 3 LLC, and they were both filed as LLCs in the state of Nevada, actually in Las Vegas. We are a real estate investment fund. We don't buy commercial buildings. We don't buy warehouses and high-rise and office buildings because they are all having some degree of difficulty with tenants and the slowing economy that we're in. We buy houses. People always have to either rent a house or own a house, but there's no other real place to live besides having some kind of condo, townhome, apartment, or house. We buy houses that are in trouble financially. Usually they're in foreclosure, short sales, bankruptcies. We buy repossessed properties because the bank will pull the property title and house back and evict the tenant who hasn't paid their mortgage or who hasn't paid their rent or paid their property taxes. That causes the owner or county treasurer of that property to take legal steps of foreclosure. I know it's a difficult economy, and I know we're heading into some kind of a slowdown. I hope it's not any worse than the 2008 slowdown, recession, depression, whatever you want to call that came on beginning in 2008. I didn't see property prices get back to where they were in 2005, 6, 7, when we were buying millions and millions of dollars worth of property till around 2014. So it dipped and it recovered, but it took 6 or so years to make that recovery. That's why it's not easy to buy houses and flip them right away. Those are very short-term profits. For you, it's better if we can hold the property as a rental for some period of time, at least a few years, and let it appreciate in value. You can usually tell what's going on by what the Federal Reserve is doing with cost of money, federal funds rate. Currently, that's at 5.5%. With the public feeling the economy is going into a recession, which they're starting to feel right now, then they're going to start lowering interest rates slowly, but lower them maybe over the next 2 or 3 years slowly. That will let the real estate market down the road 2 or 3 years have some kind of recovery in pricing. And so the more houses that we buy in the slowdown, the better the prices are, because we do pay cash and we do go with a 10-day escrow. That gives us time for an inspection, and you will have a more professionally done house deal that we're going to rent out for a few years. We're going to renovate it to the standard it needs to be desirable by the tenant who will pay a higher rent, or to the owner that wants to buy the property from us. I want to tell you something about our offering. This offering is a Regulation D 506C offering, only for accredited wealthy investors by SEC law. We don't control any of that. It makes it even harder to find those really wealthy investors, but the SEC requires it. And that investor must prove their suitability either by net worth or by earnings per year, and they have to prove it with tax returns or documents. It's again an SEC law, so that the people that take advantage of these early deals for wealthy people, because there's risk involved, SEC need to know that the people can afford the loss if there is one. So the government sets it at $1 million net worth, not including your own home, or an earning of $200,000 a year for 3 years, and the current year if you're single, or $300,000 a year if you're married for 3 years. So these are the requirements of the SEC. The benefit of it is that we pay cash for everything we buy, and therefore we're going to be able to buy at much cheaper prices. We bank wire the money. It's a 10-day escrow. We do an inspection of the property and a report before we sign off on the purchase. And if it reads okay, we realize there's damages. We realize they need repair. That's all incorporated in the price we pay for it. We take those things in consideration. But we don't want to be surprised. We thought it was $20,000, it's $50,000. Those are very hard problems to overcome. We are going to pay our investors 8% per year income, interest income, on their invested money in the fund. That's a very high rate, and the only reason we can do that and make money is because we are doing it by paying cash that we receive from the investors, and therefore we don't have any mortgage payments or hard money loans. Interest rates are up around 15 to 20% right now. To borrow that money and have to leverage 80, 90% debt and 10 or 12, 15% of equity. We have 100% of equity, try to have no debt, and everything we make is just pure profits to the fund because we don't pay that big expense, which is the mortgage or the cost of the money. We do pay property taxes, we do pay for maintenance, we do pay for a gardener, certain assets that we need to supply to a tenant who rents from us for 1, 2, 3 years or so. And before we put it up for sale, we look at the economy. And right now, the federal funds rate is at 5.5%. That's what the Federal Reserve has got the interest rates at. Even United States Treasury bonds, 2 years, are around 5% now. So we're paying a pretty high 8% return, and there isn't a terrible high amount of risk. Everything has risk. We can't control every event in the world that can happen and may happen, and that's all we can do is set up guidelines under normal economic conditions. That's how we have to run the company. These percentages we use will pay all the bills, pay management our 4% to run the company, the management company, and provide all the services for the fund. The fund will pay all the services we need for repairs, for utilities, for gardening, for property taxes, because it's their property. But what we're trying to do is do all that and give you at least 8% interest on your money, which is a very high return to you. I'd like to take a moment and explain to you about how we buy the properties and what's involved for you and why we're able to make a profit on them. Our fund has several sources of income. Renting the property is a big source of income. We can do 6-8% a year net on the rental of each house, mainly houses. And we can also have tax lien certificates on real estate properties that we buy for many of the 5,000 county treasurers in the United States that sell them every year on properties where the owner didn't pay their last year's property taxes on time. As soon as you fail to pay your property taxes, the county treasurer where that property is going to put a lien on that title of your property, and they're going to sell that lien to some investor. The banks and insurance companies are the biggest investors into tax liens and tax deeds, and I'll explain the difference, is that when you're doing the lien, it has a 1 year, 2 year, or 3 year time period for the property owner, their heirs, the lender, or a mechanic debt on the property title can pay off that tax lien. And the bank who is the lien holder is going to be very anxious to get a hold of the title to your property. You're going to be moved out of your property by court order. Marshals will come and you'll have to take your personal property somewhere else. And the owner of it now gets the keys, they'll change the locks and go into the property. We want to be on the buying side of these kind of properties that are being sold for cash only. The general public never gets to see these properties. Most of these properties need some kind of renovation. Most of these properties will not give you the kind of return you want because you have a lot more expenses like a mortgage on that property, which eats up most of your received rent. We in turn have no mortgages and no debt, and that entire rent we get is going to be mostly paid to you, the investor. We also make a profit on those tax liens and tax deeds that don't redeem, because if they redeem, we're going to make 12, 15, 20% a year interest on your money. But if they don't redeem, we're going to take the title to that property because nobody else can redeem that property but us. And we're going to go into the courts, get a title transfer by the judge signed off, and that property is going to be put in the fund's name, and we can do anything we want with it, usually rent it or sell it. So there is a new income. Either we get the interest on the tax liens or we get the profit when we foreclose or sell off the property from the price we paid for it, which is usually pretty low, until the net price we sell on a retail sale. I'd like to tell you we have some exciting things as promotions for the earliest and larger investors who can put in $1 billion or 500,000 or 250 or 100. Everybody who just buys one unit or two or three, they're $25,000 per unit. But if you're able to put in a larger amount of money in the early part, we'll give you special incentives. Many wealthy, accredited people who are supposed to be millionaires, they have that kind of money laying in their bond account or their stock account. And 8% return plus is a very good return to consider for part of your money, especially your pension and IRA money. We don't start the fund owning properties already because they may be leftovers from who knows where they got them. We go out with the money we raise and buy used properties. This fund, 506C, will allow you after 1 year to sell your units on any stock exchange that takes accredited investors only, because they have to prove they're accredited, that can do those transactions of a buy and sell. That's up to you for what you asked or sell it for. And the buyer, you guys, like the normal stock market, want to buy some Tesla, it's a bid ask. How many shares you want? What do you want to offer? This is a $25 million raise that may go on a year or two as we accumulate more and more real estate that will raise the amount of rental income, the interest earned on tax liens, the net profits on opportunity to sell properties off, and you'll understand how we're able to pay those yields, 4% to management to run the company, and still make a net profit. And talking about a net profit, every 2 years, we are going to take the net profits that are left after all bills and expenses and payments to investors have been made and to management, and divide that every 2 years, where half of that money goes to the investor group, and they divide it up by the number of units each investor owns. And half of the money goes to the management group, and we'll share that among independent contractors, employees, and managers. That's a very important part for you. So you've got the right to receive a pretty high income. We're paying cash for all the real estate, so there's not a lot of risk in paying cash. That means no debts. We're also going to have a unit, like a share of stock, that you can sell anytime after 1 year. Under SEC Rule 144, the SEC allows you now to sell that share you own. It used to be you were locked up for 10 or 15 years. Now, under Rule 144, you can sell some or all at the end of 1 year. Means you're going to be pretty liquid, or you can stay with us and just keep getting those big checks we're going to send. There's a number of ways that you can invest cash you have you may not even think about, but there's trust money, there's IRAs, there's pension plans at your company. If you have a big company and it has a lot of employees, you can put in millions of dollars in for those great yields. So they might be pretty good for you to look at. And a lot of our prior investors, we've had a little under 200 millionaire investors since we began doing this in 2002. And we have raised that millions of dollars per fund to go out and buy the same kind of properties. We were in the '08 crash. We started in 2005. By 2008, I already had almost $1 billion purchased real estate with titles or tax liens or tax certificates on those properties, all managed by county treasurers with parcel numbers, county assessed values, and information in writing that shows the kind of property. I have pictures of over 100 houses. We bought land, we bought farms, we bought vacant lots in the city. We sold them all, having purchased over 5,000 properties on tax certificates alone. They've all mostly been redeemed, or we've foreclosed, got the property and sold it, made tremendous profits on those. So all I can tell you is we're a relatively stable company. I've been on Wall Street for most of my life. This is a very easy to read 3-page replacement for you to get a general idea of the offering from this 90-page SEC required prospectus on this offering. You can see how many pages, legal pages to read. This is just a little light summary. You'll have to get this prospectus too, and you'll be able to decide if it's the investment for you or not. But you're only in, the most time you have to stay is 1 year, and if you don't like it, sell your shares. With an 8% yield. You may find out, like bonds, that's pretty attractive and could be a very interesting stock for buyers to look at. So I feel that it's a pretty solid, safe investment. I don't want to risk my money. We can't remake it. You shouldn't take any risks unless you feel you can absorb the losses and you spoke to your lawyers, your CPAs, your financial planners, and your spouse. Call for more information, and thank you very much.